Good morning, everyone. I'm Chris Sandlin, GeoPhy's Senior Director of Marketing. Welcome to our Tenant Financial Health webcast with GeoPhy's Chief Economist, Nils. In addition to his work at GeoPhy, Nils has been a professor of real estate finance at Maastricht University in the Netherlands for almost 15 years. In a moment, he'll be providing our Q1 update on the financial health of tenants in U.S. multifamily properties. GeoPhy hosts this webinar shortly after the quarter end. Please look forward to our next broadcast for Q2 in early July. The Tenant Financial Health series grows out of GeoPhy's capabilities. It's built off proprietary data and provides greater granularity to our insights than you usually receive in the commercial real estate market. It also reflects our core values. We're respectful, especially of your time. We avoid fluff to get you the information quickly. Nils's presentation will last about 30 minutes, after which we'll have time for Q&A. We've muted all microphones except the speakers. And if you would like to ask a question, please post it to the Q&A feature here on Zoom, and I'll raise it with Nils. And finally, we will be providing an archive of this webcast. It is being recorded right now. Please look for an email notification sometime tomorrow and pass it along to any colleagues who would find it beneficial. And now, take it away, Nils.
All right. Thank you, Chris. And ladies and gentlemen, good morning or good afternoon. Chris, you can go to the next slide. A lot happened since our first webinar in early January. The weather got better, with the exception of yesterday. But most of all, it's heartening to see that at this very moment, about 41% of the American population has been vaccinated with at least one shot, and that's almost one of the 35 million people. Life is getting back to somewhat normal, even though we're not fully out of the pandemic yet. And the reopening of the economy is also reflected in today's webcast, which is showing significant improvements in the financial health across the 43 million renters in the US. What I'll be walking you through today is the current state of the financial health of multifamily tenants, as well as changes in that over the last 12 and 3 months. In the last 12, obviously, really the period since the pandemic started up until now when we're coming out. The analysis is based on consumer credit data on virtually every multifamily resident, and the data is ending as recent as March 31st, only a couple of weeks ago. So the analysis are both granular as well as timely. Also provide you with some additional content, not necessarily on tenant financial health, but more on migration statistics, which is also based on our consumer credit data. Little advanced warning, I'm an economist, I like numbers, and we'll show you lots of those today. No real math, no equations, no regressions, but if things are unclear, please feel free to ask questions in the Q&A or the chat. All slides will be made available to you. And if you want to chat further after this webinar about specific stats or the data, please let me know. Just to be sure you're coming out of this webinar with the main takeaways, I'll give those to you all the way at the end. So that's a little teaser to stay on. So let's first start with defining tenant financial health, which is the central theme of today's webinar. And on the next slide, I'm giving you a little overview of the credit payment hierarchy. For those who were on the call about 3 months ago, I briefly talked about this. I'll talk about it again because it's so critical to really understanding the data that we're using. So given that most people, you and me, use credit, think about credit cards, bank cards, mortgages, but also car loans, student loans. Using credit payment data provides an incredibly detailed view on the financial situation of individuals, tenants, but also of owner-occupiers. In the waterfall of credit payments, we know that payments on secured credit, such as car loans and mortgages, come first. Retail cards like American Express, Amazon Visa, etc., and bank cards come next, followed by unsecured personal loans as well as student debt. Understanding the extent to which tenants are using credit and making payment on each of their credit lines is really important, because after all, exactly that payment behavior can be a leading indicator for rent payment behavior. So while you as an investor or lender can really predict the future on rent payment behavior, using tenant credit data, we think you can. Credit data can really help investors and lenders prioritize where to play. It can help to identify target properties. And of course, it's a useful piece of information for risk management purposes. So a bit more on measuring the financial health of tenants and assets. So today's webinar is featuring GeoPhy's data on the credit profile of each tenant in each multifamily asset across the US. That's data that comes directly from financial institutions, I think banks, etc., to the credit bureaus. And that's then used for the calculation of credit scores that you're probably quite familiar with, delinquency rates, etc. We aggregate the information on individual consumers to the asset or property level with a minimum of 10 consumers per property. So we can never identify an individual tenant, and neither would our users be able to do that. So that's really important. In today's webinar, we focus on three key metrics: the average credit score in a multifamily property, the average delinquency rate of tenants in a multifamily property, and the third metric that might be relatively new is the so-called payment holiday. The payment holiday is a special type of deferment granted by credit card companies, mortgage servicers, and that has become especially relevant during the pandemic. It existed before, but it wasn't used a whole lot. So this payment holiday is important to understand. Under the first CARES Act, Act 1, 12 months ago, the stimulus package also included a payment holiday provision, and that was granted to any consumer that applies for that. We consider payment holiday, in fact, a kind of a hidden risk. It's a non-payment risk that is captured neither by credit scores, which don't take payment holidays into account, nor by delinquency rates. In addition to these three credit metrics, we also capture data on household counts in each multifamily property. People register their address with banks, credit card companies, etc., when they move into an asset. And as such, household counts for each property provide a pretty accurate measure of occupancy. And if you start to aggregate that at the neighborhood, metro, or state level, this data provides timely insights into migration patterns, particularly or especially as it relates to multifamily property. I'll talk about that later. So some more on credit metrics as a predictor of the stress or success. And I mentioned that in the last webinar that we're working on some research here. We did a backtest relating credit scores of assets financed by Fannie and Freddie to subsequent bad debt expenses. This backtest is using pre-pandemic data when rent collection rates were obviously high and bad debt provisions were low. But even during that time period, there was a clear correlation between the average credit score on an asset and rent payment collection rates. For multifamily assets with a credit score ranging between about 590 and 640, and you'll see in a second that's not far from the US average in multifamily assets, bad debt is about 75 basis points of total rent, gross income. For those assets with a credit rating above 700, the bad debt provision is about a third of that at 20 basis points. So you see it in the graph here as well, as credit scores increase or decrease, bad debt provisions go down or go up. Of course, as an economist, I need to say here, correlation is not causation, but these numbers show that understanding the strength of consumer credit in multifamily assets, as well as the changes therein, can help investors and lenders in their acquisition, underwriting, and risk management decisions. Then finally, before we dive in, a quick note on GeoPhy's multifamily universe. And that's always the number one question: what do you cover? So we base our analysis on a large sample of multifamily properties. And I would say we cover pretty much all of the US. As a reference, the Census ACS, the American Community Survey, kind of the gold standard out there, counts about 500,000 multifamily assets with more than 5 units, with GeoPhy covering about 92% of that by units. So we cover about 23 million units across the US, and we cover about 62% of the Census ACS universe by properties. That's 326,000 unique multifamily assets spread out across the US. Now, in some of our analysis, you'll see that we've focused on the top 50 metropolitan areas because that's where most of the people are, as well as where most of the multifamily assets are concentrated. And that's still about 17 million units and 237,000 multifamily properties. So I think what we present here today is really quite representative of the universe that investors and lenders in US multifamily assets would care about. All right, so let's dive into the financial health of tenants, and we're starting with the state of the nation. I have a chart here that summarizes it all for you. It gives you a good, nice macro view on tenant credit, and I would say that view is pretty good. You know, economists are not known for their optimism, but I would say the view is pretty good. So the Fed recently reported that there's now a record $17 trillion of consumer deposits stashed away at commercial banks, and credit card balances are at their lowest level in 4 years. And you can see that in our data as well. When we focus on the US multifamily sector, we see that the credit score of multifamily tenants across the US is higher than ever before at 653. That's a full 10 points higher than it was a year ago. And it's about 3 points up in Q1. So to put 10 points into perspective, a 30-point increase in credit scores lowers the default rate by about half. So 653 average credit score for US multifamily tenants, higher than ever before. And that's quite striking against the backdrop of the pandemic that we've seen. But of course, it makes a lot of sense if we think about the monetary policy in the US and the provision of stimulus packages. The average delinquency rates across multifamily properties is 46%, 45.9 to be precise. Now that may seem very high to you, but please note that this reflects a 30 days past due on either one or more credit lines, including student loans. And even pre-pandemic, about every 1 out of 2 Americans was delinquent on some of their credit. So that's kind of the standard in the US. In fact, since the start of the pandemic, the delinquency rate is down by 1.4%. And over the past quarter, the delinquency rate further decreased by 0.3%. Again, quite a positive trend in the financial health of renters. Now then, the payment holiday is a source of hidden risk. Indeed, one out of every 20 tenants is on some form of payment holiday. It's not your dream destination, but it's a holiday as well. And that's almost double from what it was a year ago. And remember, April 2020, we were only really getting started in the pandemic. Now, the good news here is that the number is starting to decrease. It will take a while to get back to where we were. And the question is, of course, whether consumers will be able to make payment on their debt once that holiday is over. So that's something to monitor over the next couple of months. Now, while I want to reiterate that on average, tenant financial health has improved against the backdrop of the pandemic, it's important for investors and lenders and all of the other stakeholders in the multifamily space to understand there's a massive variation underneath those good-looking averages. If we look at all 326,000 multifamily properties, about a quarter of the properties saw no large shift in average credit scores over the past 12 months, as shown by the teal bars here. And teal, kind of, that light blue, if you will. 63% of properties had an increase in credit scores, but on the flip side, 15.5% of properties saw a decrease in the average credit score of more than 5 points. And again, at the level of the individual consumer, a 30-point change in credit score equals a doubling of the likelihood of non-payment. So imagine that a single property sees an average shift in credit scores of more than 30 points. That's quite significant. Now, in this case, almost 10% of the stock, of the multifamily stock, saw an increase in average credit scores of more than 30 points. So that's actually quite good news. Whereas just 1.4% of properties had an average drop in credit scores of more than 30 points. The graph here also shows the 12-month change for Q4 2020. So we show both Q1 2021 and Q4 2020. And what we see if we compare the blue bars, Q4, with the teal bars, Q1, is that there's a clear deceleration in credit scores going down and an acceleration in credit scores going up. So good news. On the delinquency side, on the next slide, the majority of properties across the US saw no significant change in that average delinquency rate of almost 50% that I presented. That's -5 to +5. And again, teal here is the 12-month period ending Q1. The comparison between the blue bars and the teal bars highlights that the increases in delinquency rates of tenants in multifamily properties are slowing down. In Q4, almost a fifth of properties saw an average increase in delinquency rates of 5 points or more. But in Q1, that percentage was actually down to only 7.5%. And in Q1, 16% of multifamily properties had a decrease in payment delinquency of more than 5 percentage points. So again, good news. There's still enough bad news to come, I promise you. So last, the payment holiday, what we call the hidden risk for multifamily income streams. So here the distribution is pretty clearly skewed. About 22% of the assets saw an increase in payment holiday of more than 5 points over the past 12 months. That's about 70,000 multifamily assets. Very few assets saw a decrease in payment holiday rates just yet. So there's really kind of work to be done. The good news here is that there's also a deceleration in the increase in payment holiday rates from Q4 to Q1, and a trend that we are pretty sure will most likely continue. Now, of course, the question is, as people come out of their deferred payment, will they be able to pick up their monthly payments again, given that the provision of payment holidays might be concentrated mostly amongst employees in COVID-affected industries and jobs. Beyond dispersion on tenant financial health within individual tenant credit metrics, there's also major dispersion going on across geographies. Now, quickly, before we do that, before we basically dive down to the states and the metros, and yet still have this slide in front of you, as we go to states and metros, we focus a lot on assets at risk. And what that is those properties or those areas where you actually saw an increase in delinquency rates or an increase in payment holiday rates of 5 points or more. So basically the block outlined on this slide is what we call assets at risk. All right, let's look at the individual states. The color of each state reflects what's happening from a tenant credit perspective as measured by the percentage of properties in each state with a more than 5 point increase in tenants on payment holiday. So just see it, the darker the state color, the higher the percentage of multifamily assets at risk. And I would say there's a clear delineation between what you see in the Midwest and then what you see in the South, and then the coast look a little different as well. And the darker the color, and the worse the situation. Nebraska tops the state with 42% of the about 1,000 multifamily assets in that state at risk. Now again, that's down from 50% at the end of 2020. Minnesota is 27% of the 3,300 properties we track at risk, and California is at 23%. Now that said, in California, we track about 71,000 multifamily assets. So from an absolute perspective, the 16,000 properties in California that we consider at risk represent as much as all of the at-risk properties in the top 25 most risky states combined. So that's California. On the more positive side, Arizona has just 13% of multifamily assets with an increase in payment holiday of 5 points or more over the last 12 months. Texas and Georgia are at 15 and 17%. And New York is kind of middle of the pack with about 22% of the stock at risk. However, given the large multifamily stock in that state, about 50,000 properties that we cover, 5 units or more, there's still about 10,000 multifamily assets at risk. So while the percentage might be middle of the pack, the absolute number is quite high. So the key takeaway here is that there's large variation in the change of credit metrics across states, with kind of good credit states. Think about it, California, it's mostly the coastal states, not necessarily doing so well from an at-risk or tenant financial health perspective. Okay, let's go into metros from states. So on this slide, you see the top 10 metros from a credit score perspective, as well as the bottom 10. So the high-flying gateway cities, including San Francisco, New York, Boston, LA, Seattle, etc., all have pretty high average credit scores and low delinquency rates in their multifamily stock. So you see the average credit score in the second column, you see the change over the last 3 months, and then you see the percentage of delinquent tenants in the third column. What I call kind of blue collar cities, worker cities like Vegas, Louisville, Cincinnati, all have average credit scores in multifamily properties that are easily 75 points lower, and credit delinquency rates that are double, if not triple. But of course, these levels are closely related to local household income and should be reflected in rents as well as cap rates. So the riskiness of these assets. Now, what's interesting is that low credit cities, if you will, beat high credit cities when looking at the 3-month change in credit scores. 3-month changes in delinquency rates are pretty similar across the top 10 and bottom 10, even though we would expect low credit cities to collapse really in a pandemic such as we've seen. Looking at payment holiday rates, it's well-to-do San Francisco, New York, San Diego, where those rates are highest, and certainly much higher than in places like Oklahoma City, Louisville, and Houston. So I interpret this, you could say, well, yeah, it's just better payment ethic. You could also interpret it as more low beta for non-gateway cities, blue-collar workforce cities, and high beta, almost in the sense of stocks, for the high-flying gateway cities. I can show you is a little more by taking the at-risk metrics. So we look here at the percentage of multifamily properties with a 5-point or more decrease in credit scores on the horizontal axis, and then the y-axis, the vertical axis, is corresponding to the percentage of properties with a more than 5% increase in the tenants on tenants on payment holiday. So just consider those two metrics different variations of an at-risk measure. So I'm showing you those numbers for 5 metros where the at-risk numbers were lowest at the end of 2020, so a couple of months ago. That's not to say it's low per se. In Atlanta, there were still 17% of the 3,000 multifamily assets there in our definition of at risk. In Austin, a smaller market with about 1,900 multifamily properties, actually quite a bit for a small market. The percentage of assets with a more than 5-point increase in payment holiday was 15% in Q4. But now look at what happened over the past quarter. In all metros, the number of at-risk assets decreased substantially, especially when it comes to that increase in payment holiday. For Atlanta, the number of at-risk assets is down to 14, and perhaps Oklahoma City is a bit of an exception with a slight increase in the assets where the credit score went down with more than 5 points. It's still relatively low at 90%, plus Oklahoma City is a relatively small market with only about 700 assets. So here's the same slide. It's in the next slide. You see the same slide. But now for the 5 metropolitan areas where the number of at-risk assets was much higher in Q4 2020. Mind you, the scales here are a little different. So you see that the vertical scale goes up to 70%, and that Jacksonville actually is pretty close to that. So 70% of the assets, that's not totally true, 62% of the assets in Jacksonville at the end of Q4, so only 3 months ago, was considered at risk from a credit perspective. Now, if you look at that now in Q1, you see a strong, maybe even economists can't really exaggerate, but you can say it's kind of a super strong decrease in the number of multifamily assets at risk in each of those metros. So Jacksonville goes from 62% of the assets at risk to 14% in its multifamily stock, which is, admittedly fairly small, about 800 properties. Minneapolis, perhaps not the top market for investors, but a big market, obviously, improved significantly as well. And of course, want to caution, we're not out of the woods yet. There's always be assets with elevated credit risk, but these trends are encouraging for those who have or want to deploy capital in the multifamily sector. One more important stratification to make within metropolitan areas, and that's property size. So here you see a table that looks at changes in credit scores and payment holiday per metropolitan area or city. Good large assets and small assets are presented separately. So basically you see properties at risk, small properties on the left in the second column, and then in the third column, the fourth column, you see the percentage of large properties that is at risk. And we define large as having 25 or more units. And of course, you can take 50, but the picture will be quite similar. So clearly large properties with hundreds of units or 25 plus units are quite different from small properties. And there's a stark contrast between multifamily assets based on asset size. In larger properties, the financial health of tenants is somewhat better. This can be seen for pretty much every metropolitan area, whether that's in the top 10 or the bottom 10. Look at, for example, New Orleans, Vegas, San Diego. Smaller multifamily assets across the board have a more risky profile from a consumer credit perspective, independent of their location. So we can go 2 levels deeper. We'll do one because we're not going to look at individual assets. You could look at this data for an individual asset as well. But let's look inside a metro area. There's been a lot of talk about the rise of Sunbelt cities, obviously, over the last couple of years, I would say, also pre-pandemic, with Dallas as a shining example, also in the literal sense. So let's talk about Dallas, but now from a consumer credit perspective. So what you see here on this map of Dallas, the monocentric city, is that there's all these little shapes. These are GeoPhy neighborhoods. Across the US, we have defined 94,000 unique neighborhoods, of which about 1,000 of those neighborhoods are in Dallas alone. We cover 2,400 multifamily assets in Dallas, scattered over those 1,000 neighborhoods. Each neighborhood is a combination of one or more census blocks that look and feel similar. We score and rank those neighborhoods based on characteristics that are related to demographics, amenities, and housing. So it's a rating that's specific to multifamily. So we highlight here the top 5 and bottom 5 neighborhoods by rating on the left side of this slide. And the legend provides the average credit score for tenants in multifamily properties within each of those neighborhoods. So you see that the neighborhoods with high credit scores are mostly northern part of Dallas, starting at the urban core with Oak Lawn, St. Thomas, Bryan Place. And those neighborhoods are often rated A or A+, as you can see in the table on the left. Now, there's also neighborhoods that have a lower neighborhood rating and a lower average credit score. So that's Old East Dallas and the neighborhoods primarily in the south. So generally what we can see, and we did a correlation for all 1,000, is that neighborhood ratings correlate quite nicely with tenant credit quality. So basically higher quality tenants sort into higher quality neighborhoods. Now, of course, we're interested in changes in credit quality, and here a different picture emerges. So red indicates a large fraction of multifamily assets in a neighborhood that has seen a drop in average credit scores among tenants of 5 points or more. So again, those are the fraction of assets at risk in that neighborhood. Clearly, high quality neighborhoods are not fully insulated from financial distress. So St. Thomas, top neighborhood in Dallas, but 11% of the tenants in multifamily assets there have seen a substantial drop in credit scores, and 41% of properties have seen a doubling of payment holiday rate. So it's quite substantial. Compare that to the C+ rated Collinwood Park and Winston Park, and it makes these otherwise lower quality neighborhoods look pretty good. So even within a metro, there's a lot of variation in the financial health of tenants. And you could use this kind of data to determine where to invest or lend, or to identify target properties from a distress perspective. We're still looking for distress. So then, as the late Steve Jobs said, one more thing. Tenant credit data can also be used, as I mentioned in the introduction, to understand whether people are packing up and where they're moving to. After all, you want to receive a credit card or your new bank card at the right address. Importantly, this data here covers just tenants in multifamily assets. So while we can monitor outflows from multifamily assets quite accurately, inflows could be underestimated if tenants buy a home instead of renting an apartment, or in case they're moving into a vacation home or a single family rental. It's not covered here. Using the data on the individual tenants and individual assets, we can now aggregate at any geographic level, whether it's the neighborhood or state. And again, this data offers great insights into where to play, which markets are losing steam, and which areas and markets are actually picking up. So a couple of slides, not too many. So first, the overall migration map of the US. It's the next slide. Oh, can I have the next slide? So I'm sure the next slide will come shortly. I'm going to show you the overall migration map of the US. And you will see the 12-month change in household count for all multifamily assets in each state. You'll see that those numbers reflect net migration, so total out minus total in. So migration within a state doesn't have an effect on state numbers. Also, note that real migration only started as of summer last year. So when people start to realize the severity of the pandemic. When the screen sharing comes back, and otherwise I'll take over, you'll see in a pretty map that Idaho and Montana have done really well, and so has Georgia. New York is a loser, losing about 115,000 multifamily tenants over the last 12 months. And California is losing more than 90,000 multifamily tenants over the last 12 months. So we'll zoom in deeper on two states in a second, California and Florida. But before we do that, I'm going to see whether I can take over the screen.
Nils, I'm going to have to offer you to share because I have something seems to have locked on the screen share here.
All right, please do.
Go ahead, you should be able to.
All right. Oop. There you go. Sorry for the inconvenience. Let's see if I do full screen, whether this is going to work. Okay. If You don't have the most beautiful view, but I'll keep it like this. And you'll be able to see the map here. So like I just mentioned, mountain states, Montana, Idaho, growing quite substantially between 2 and 4%. Same holds for Georgia. And this is the last 12 months. And it's really important to realize, you'll see it on the next slide, is that the real migration only picked up as of June. And in fact, some states that grew subsequently, like Florida, saw a net outflow in the first quarter of 2020. All right, so let's take a look at California. So last 12 months, tenant migration in California for different areas, purely focusing on multifamily. So what you see here, that the San Francisco Bay Area as of March basically went down, 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 and the end is not in sight. And we'll continue to monitor this, and we'll come back in 3 months to report the state then. So while there's reports of leasing activity picking up in the Bay Area, that's absolutely true. There's also supply still coming on the market. So net, we see that the Bay Area is down about 6% of its multifamily tenants. The Inland Empire, quite interesting. First went down, and then right about June 20, when people started to move out of cities like LA, you saw that the growth will start to pick up. Now, I live in California. Bakersfield is probably not your favorite place to move to, but there's quite a beautiful places in the area. I was going to say, if people move to Bakersfield, then situation in LA must be pretty bad. So the rest of California, pretty stable, but still down about 1% in tenants, and the rest of LA is down about 2% in tenants. So that's the view on California. So within a state, and that's important, the numbers can be quite different. So here's Florida, also quite interesting. First quarter, even until about June last year, you saw that Florida was losing net was losing tenants. So rather than hedge funds moving in, hedge funds were moving out. Now that started to change pretty rapidly in June of last year. Tampa, Orlando, the beach cities, quite rapid growth. So 3-4% increase in tenant base, which is really quite substantial if you keep the stock constant in the short term. Obviously, when you start constructing, we'll get into either equilibrium oversupply pretty quickly. Miami gained quite a bit in terms of tenants, and then Jacksonville, Gainesville, Tallahassee. So some of these important student towns actually continue to lose tenants up until about this year, and are down to the 3% in these individual cities. So while Florida has seen substantial influx of tenants, it's not for every place in Florida. Also important to mention here is that, again, we only measure the effect here of migration for multifamily. So if people moved into single family homes, condos, etc., that's not measured here. And second, if people don't register their address formally in Tampa, we won't pick that up. And we've heard that quite a bit, that people kept their primary residence back home. But then if you bring your kids, at some point you got to register in order for them to be eligible for school. One more slide on the largest core-based statistical area, so largest cities. What you see here on the vertical axis, so y-axis here, is the change in multifamily tenants over the last 12 months of 2020. So that's Q4 T minus 12. And what you see in the horizontal axis is the last 3 months. So what's interesting on the top right, there's COVID winners, right? Growing in 20, continuing to grow in 2021. Tampa is kind of a consistent grower here. Houston doing well, Orlando doing well, Salt Lake City, Utah, we've heard that name come back a lot, but also upstate New York here, Buffalo. And again, it's like moving to Bakersfield. If Buffalo is growing, people are either optimistic about global warming or really desperately want to get out of New York City. We have some temporary winners. So those were basically growing last year, but started to shrink from a tenant-based perspective in Q1. Actually interesting, Dallas is there, San Antonio also in Texas. Now we see Cleveland and Cincinnati. And then bottom left are COVID losers. Might be a little harsh, but those are metro areas, so larger cities that were showing an outflow of multifamily tenants, both in 2020 on the vertical axis, as well as into the first quarter of 2021. Not surprisingly, San Jose, San Francisco, gateway cities, Boston is there, Chicago is there, DC is there. But what I found interesting also is that, for example, Denver is there. Now, this may just say that in Denver, people moved out of an apartment building into a condo or into a single family home, either owner occupied or rental, or they all decided to start living in the mountains, which I think is a good choice, and out of Denver City. But while we have heard a lot of good things about Colorado, Denver as a city actually has been losing tenants over the past year and also into Q1. This is just a selection of the top 50 metros. If you want to see other cities, let me know and I can plot them for you. So there's a few on COVID recovery as well. They're smaller cities. All right, to wrap that up, tenant financial health is on the rise, along with our vaccination rollout and along with our own personal health. Credit scores are up, delinquency rates are down. So that's really good news. Now, payment holiday is not reflected in either number. We call that still a hidden risk. And payment holiday rates are still quite elevated. More than 21% of multifamily properties have seen an average increase in payment holidays of more than 5 points. In the first quarter, there's some bright spots with payment holidays slightly decreasing. The question is, what does that mean? And are people able to make payments again on their credit, second mortgages, etc.? We see massive geographic dispersion between as well as within metropolitan areas, and so-called blue-collar workforce cities actually look much better than what I call the high-flying gateway cities. Property size matters for the financial health of tenants. Smaller assets generally have more hidden risks, so that's something to consider, and it's less than 25 units. And at last, migration patterns can be informed by tenant credit data. Georgia, Texas, Sunbelt City are winners, and what I then call the high alpha cities are losers. So with that, Chris, I'll turn over to you.
Fantastic, Nils. Thanks very much. We've got a few questions that have come in. If you'd like to ask a question, please make sure to add it into the Q&A function that's on your screens, and keep sending them. We'll respond by email if we don't have time to answer them all. I've got a couple here already, Nils. The first one is, can you detail how you collect the credit information that you've built this report on?
Yeah, I make a phone call to every building. No, so basically what we do is we partner with one of the three credit bureaus. So you guess one, but we put in one of the three. We give them a list of all multifamily assets across the US, and the data is aggregated at the individual building level. So we take a lot of care to make sure that we don't have access to individual credit data. And then importantly, we receive that data every month, and we receive that for March, a couple of days into April. So you really have these fresh statistics, which I think that timely data is really important. But equally, it's highly granular at the level of the building, and from there you can aggregate at any level you want.
Excellent. And the second question I've got here is, why the focus on the tenant credit holidays?
Yeah, that's a good question. What we've seen is that these metrics are correlated with subsequent rent payment behavior. So you're looking for a proxy on what's going to happen in assets, both kind of the good, the bad, and the ugly. And as a larger fraction of tenants in assets are on payment holiday, that is a forward-looking indicator of financial distress that is ultimately also correlated with rent payment behavior. And you see that also for credit scores as well as for delinquency rates. But that payment holiday is something that's really relatively novel and came out through the pandemic as a pretty strong indicator.
Excellent. Okay, well, thanks again, Nils. And thanks everyone for attending. That's all the questions that we've seen so far. And a quick reminder that we'll be sending along a recording of the event tomorrow. And also that GeoPhy has all the data that you've seen today down to a property level. If you have any remaining questions or comments, please reach out to us at info@geophy.com, and we'll answer them as soon as possible. See you all again in July for the Q2 update.